Welcome, everybody, to Crossing the Line, where each week we dig into the latest news on the economy, housing, and whatever else caught our eye this week. It's usually some pretty good stuff. It's February 5th, Monday morning. Not bad weather out there. A little cold, but at least it's not raining. And this is our 12th episode, Hannah, so we've hit a dozen.
Yes.
But I guess you're not really a show to hit the baker's dozen, right? Because it's just not.
Right, that's 13, right?
That's 13. Although, anytime I buy a dozen bagels, it's always, they give you 6 free. So maybe it's not, maybe it's 18 we'll feel like we've really arrived. As always, a special welcome to all first-time listeners out there. Please make sure to like and subscribe and check out all the other great podcasts on the More Network. It's a very diverse group of people talking about a very diverse group of subjects. I'm Chief Economist Greg Heym here at Brown Harris Stevens and author of The Line, a weekly economics blog with over 2,500 subscribers. And I thank each and every one of them if I could. Joined as always with my co-pilot Hannah. How's it going, Hannah?
It's going great.
All right, that's good to hear. We'll stop there. Then we don't ask too many. Once you get a great, you move on. And Ray and Lena behind the scenes, always making sure we're on time and looking good. You're not allowed to clap. Ray, I don't clap for myself. You're certainly not allowed to do it for you. No, it's fine. As always, we're coming to you from our beautiful home, actually now more beautiful home at Studio 1873. Those of you watching on YouTube, hi. And you may notice that we have this great new decor thanks to our friends at Everset.
Yeah, it looks beautiful in here.
Does it?
Nice and fresh. We got a facelift.
You know, we did keep the Ron Guidry bobblehead, and we have our mugs. But
that's a necessary
we needed a sprucing up, and this looks great.
It does.
And this is something they can look forward to, I think.
Right.
So
it'll be swapped out for fresh decorum.
So, you know, just like the subjects will keep changing, we'll have fresh new looks. I may have to buy a new wardrobe for all that, but we'll take it one.
Yeah, you can work on that.
One new thing at a time. I'm too old to change. Again, always trying to be informative, concise, entertaining, edgy, and new decor all at the same time. And for any feedback, there's always ctl@bhsusa.com. Well, let's get to the line item. It's not plural because there was really only one thing in the line this week when you have a jobs report.
Right.
And it's another one of these crazy what the heck is going on things. We could spend, a half an hour talking about that. But, the headline was
353,000 jobs added in January.
I was going to put like a headline like I give up or enough already. Like, when is this going to end? Because we've just had this series of better than expected job reports that, just seems to keep coming. And to show you what a blow-away number this was, the Dow Jones forecast was looking for 185,000 jobs. So this is almost double what anybody was looking for. So, and I didn't hear any economists, even individually, calling for 353,000 jobs. Let's get to the highlights and then dig a little deeper into it. The unemployment rate held at 3.7%. It had been expected to go up a bit to 3.8%. Largest job gains in professional and business services, that was 74,000 jobs, and healthcare, 70,000 jobs. Professional and business services, a little bit of a surprise. No one really saw that one coming. Healthcare, tourism, hospitality have been kind of driving gains. That's not a surprise. Another thing that was, very surprising was that the job gains in November and December were revised up by a total of 126,000. So that makes this even more impressive when you think about it. I don't know how often our viewers think about it and listeners. I'm paid to think about it, so I'm stuck.
You enjoy it, though. It's a passion.
I tell myself I think nothing makes economists look dumber than data that is always coming in above forecast. Like, we should have just gotten it at some point and just started really going way high on our predictions. But this is why I don't make predictions. Average hourly earnings up 0.6%. That was double the estimate. Remember, that's a monthly gain. Over the past year, that number is hourly wages are up 4.5%. That is above the 4.1% estimate and above the level of inflation, no matter how you measure it, whether it's the PI brothers or core PCE, the cooler cousin.
Yes.
One sign to kind of level things off a bit was the average hours worked, which declined to 34.1. So again, sometimes we use wage growth and our average hourly earnings interchangeably. They're not. You know, if I'm paying you a little more an hour, that gets negated if I cut your hours. Hey, I'm doubling your salary, but you're only going to work a quarter of the hours. You know, something like that. So that's a little bit of a dose of reality. The wages are growing up, just like we talk about the consumer price index. Prices are going up for things, but if you're not buying those things, you don't really feel an impact. Or if you switch to cheaper things, the old steak is too expensive, I buy chicken.
Right.
That's why we like core PCE. What are we really spending? Ray doesn't like either steak or chicken. I had to see. He made that face. I can't make a vegan comparison. I don't know enough about vegan food. All right, so there are reasons why this report is both surprising and not so surprising.
Tell us why.
Thanks for the cue, because I was on the fence about doing it, Hannah. So, all right, let's see why it's surprising. Well, there was a lot of negative stuff that came out before. So, as you know, my faithful readers and listeners, the jobs report almost always come out the first Friday of the month. Usually a couple days before that, on Wednesday, the ADP number comes out. ADP obviously is a very large payroll company. They handle our payroll, I believe. Mm-hmm. And they come up with their own private sector employment estimate, and their number for January was only 107,000. That's private sector, but then again, you typically don't expect government to add a lot of jobs. You may remember they did so in December, but not so much in January. How does that happen? Different surveys, different results. You would figure ADP would have a pretty good handle on this since they're making sure a lot of the American workforce gets paid. But, you know, different surveys, different results. One of the interesting things about, you know, we've talked about this before, is so we have the payroll survey or the establishment survey where companies send their payroll data to the BLS, Bureau of Labor Statistics, aka my first employer out of college. That's where we get this monthly job number and wage information. But then when you talk about the unemployment rate, that's taken from something called a household survey, where we call people up, ask them if they're working. If they're not, we ask them if they're actually looking for work, because you're not unemployed if you're not looking. They also calculate an employment gain each month, and that survey showed a 31,000 job decline. So that's a big difference, and there are reasons for that. The household survey is a smaller survey, less accurate. They also capture things in the household survey that aren't in the payroll survey. If I start my own business, that's not necessarily going to show up in the payroll survey for a while. It's not really going to be big enough to matter, but you know, a lot of small businesses get started. So that's another thing to keep in mind. Another thing that had us really prepared for maybe a downside surprise was there is a firm that tracks layoffs, job cuts, and the name is Challenger, Gray, and Christmas. It's funny that I know this. I'm not the first person to make this joke, but it's the first time I've done it on this show. Everybody gets one, right?
That's true.
That a company that
We'll
talks
allow
about
it.
cuts has Christmas in the name. They said that January had the highest level of job cuts since early 2023, a little over 82,000 job cuts. So that came out again before the jobs report on Friday. So you're thinking, all right, they're cutting jobs. Are they cutting and hiring at the same time? Apparently they are. Another thing that had people, you know, again, tempering, I think, their expectations was we hit a really low number a couple of weeks ago on the claims for unemployment. You know, it was the lowest number, I think, in 2 years, but after that, it was the lowest since 1969. We joked about it. But in the 2 weeks since then, jobless claims are now up 35,000. So jobless claims rising, this talk plan layoffs rising, the ADP number weak. You could see why people might say, maybe this isn't going to be the best week. Maybe it's not going to be almost double. Well, another thing that we look at is job quits. A lot of people quitting their job shows confidence in the labor market, which means jobs are pretty plentiful. Quitting was down 12% last year.
That's interesting.
So, and this is like a segue into the not surprising. Now, there is something called the JOLTS report. It has nothing to do with caffeine or electrocution. It stands for the Job Openings and Labor Turnover Survey, again, conducted by my former employer, the BLS. So the number one thing in the beginning, the JO, is job openings, and they hit a 3-month high at the end of December. So with all these new jobs out there, and again, these numbers, it's not over 10 million anymore, but these are still numbers that had never been seen. I think it's in the 2 decades that BLS has been doing this report. So that shows you that companies are still begging for people to come work for them, even with all this talk of layoffs. So you see this rise in job openings to a 3-month high in the month right before, obviously, this employment report gets calculated, and maybe that shouldn't be such a surprise. Labor turnover is the other part of that, and the quit rate, again, is down. But remember, last year things were even better from an economic standpoint. So it's not the fact that job quitting has gone down from where it was a year ago isn't a big surprise. Another reason maybe we shouldn't be so surprised is the BLS does make sometimes dramatic adjustments to this data. They do something called a re-benchmark every year, and there can be very large adjustments. Now, so they every time they release a report, like in this report, they have revised data for November and December. So they do that every time, but then each year they go back and readjust all the data from the prior year. And in March, we get that finalized information. And there can be dramatic swings. You know, I was looking back when we talked about the December report on how the jobs report came out versus forecast, and like 70% of the time it outperformed expectations initially. But then when you looked after the revision, some of those months changed. So keep in mind, you know, you always wait. We're always in a rush to get data out. You know, I have to do these quarterly market reports. They want them out the first day after the quarter ends. That's not going to be complete data. There's going to always be a large amount of data that comes in late, and you get better numbers from your second or third estimate. And BLS, one of the major reason that they make a lot of these adjustments, and they're larger, has to do with seasonal adjustments. Like, for example, there's typically a big decline in jobs from December to January in retail.
Right.
So you put holiday season help
You
on.
hire a bunch of people and then...
Or in the summertime, you know, lifeguards get hired, so
Right.
you have an adjustment in place for that.
People at the local ice cream shop on the shore, you know.
Right.
That
You know,
closes.
those hooligans in the Jersey Shore go down there.
No, not hooligans.
Get cheesesteaks and...
Patrons of the Jersey Shore, you
sure,
mean.
let's go with that. They should spend more time in the mall. But
The slander is awful.
we haven't mentioned the mall. I'm sorry, we won't get into that. But, you know, for example, if you think of the last decade, let's just say, Christmas hiring isn't what it used to be. Because,
Right.
you know, traffic in malls, most notably the American Dream, is not what you would expect. So they have to tweak that. And again, another thing is the cut in hours worked. That's happened in December too. That was also something that we noticed. So, you know, maybe wages are going up, fewer hours work kind of balances it out. So maybe it's not a sign of this tremendous strength. But finally, it all boils down to this. Why should this be a surprise at this point? It's happened so often. The economy just continues to outperform expectations. Why should this be news? You know, we should just accept it and just live with it and be happy. But there's a dark side to this, which we will get to when we get to the lineup. But before we get to the lineup, now that we've been very successful, and, you know, we have a hit.
Massively, yes.
Right? We had the pilot episode, and
Yes.
we've cleared that, and the ratings are good. You know, now we're big enough that we actually have to take a break right now for this word from our sponsor.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
And we're back. I always
Yes,
wanted
we
to say
are.
that in my best radio voice.
You did a great job.
Well, now that all my dreams have come true, and we have Ron, did you ever think this? I'm talking in my bobblehead.
He said no.
I may never go 25-3 and like he did in 1978, but we now have to take a break for commercial messages. It's awesome. Thanks to our sponsors. And again, thanks to the viewers out there. We wouldn't be able to do this
Of course.
every week without you, and we appreciate it.
Well, should we get into the lineup?
We should, and who's leading off in the lineup?
Well, that would be me. So Fed rates are holding steady, but not quite ready to start cutting.
So, and it's important to remember that the Fed's meeting and the decision came out before Friday. So this
Right.
is pre-jobs report, which only would have solidified this. But, it said again, look, we're done raising rates. You ain't got to worry about that. But we're not ready to start cutting them. So you're just going to, and we joked about this, that anybody who thought it was going to happen in March was really, wrong. Let's put it that way. I think this is more of a second half of the year thing. But, they issue a statement, that's as bland as they come. It's kind of what I do with some reports that I do. You just kind of change the numbers and leave the other words as there, because it's so C-spot runish. And the Fed, they probably sit there for these 2 days they meet and they go over every sentence of this because it can scare markets like that.
Right.
But this statement had a lot of cross-outs in addition. There are a couple things that they said that, bear repeating. And again, I'm sorry about the blandness of this. If I wrote this would be a lot more interesting. But the committee judges that the risks to achieving its employment and inflation goals are moving into better balance. The economic outlook is uncertain. Isn't it always uncertain, Jerome Powell? And the committee remains highly attentive to inflation risks. Well, actually, that's your job, Fed. So that, but basically, they're saying it looks like that soft landing is coming. The moon thing is we're landing on the moon and everything's good to go, and we're not going to let Neil Armstrong jump out yet, but we're there. But again, our job is to keep an eye on inflation, one eye on inflation, one eye on the economy, and that was the way they said. They should have said it like I just said it, I think, but
Yeah, that would have been more interesting, but
and then is to saying like why they're not cutting rates. They said, quote, in considering any adjustments to the target rate for the federal funds rate, target range for the federal funds rate, because it's a range, it's not an actual number, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving substantially toward 2%. So, again, in a much simpler vernacular, that basically means that we're not cutting and don't expect us to cut soon.
Right.
Again, we look at the core PCE is still running significantly above their 2% target. So why are people getting their hopes up high? Wishful thinking, or the Fed has to worry about causing market declines and stock market panics. So I think in some cases they're trying to bully the Fed into doing something that would be, I think, irresponsible. And just to hammer it home, Jerome Powell, the Fed chair, went on 60 Minutes. I'll admit I didn't watch it, but I typically don't watch 60 Minutes.
Really? It's so great. I love it.
You know what? I'm usually at the Jazz Jam at Gusto Divino on Sundays, or I probably should have been watching the Grammys because I heard that was pretty interesting. But they basically maybe we can get to that in a minute.
Personally, I would rather watch 60 Minutes, but that's I'm probably in the minority.
That's because it's only a 60-minute commitment, right? The Grammys I heard was a 3-hour extravaganza.
Was it
closing
really?
with Billy Joel? I mean, doesn't get better than that.
I gotta watch the rerun.
If it was Springsteen, you would have watched it. So he basically reiterated what the Fed announced, and he said that expect fewer rate cuts than you think. He's kind of raising his hand, doing the Jedi mind trick. You don't want that many rate cuts. We'll see what happens. The bottom line here is, and we've said it before, the economy does not need rate cuts. It's doing just fine. Do we want them? Yes. Would we like lower mortgage rates? Of course. Mortgage rates actually went down a teeny bit last week. We'll see what the Fed said and what the January jobs report showed, what that will mean to mortgage rates this week. But obviously the stock market has not been happy about this. And they're just going to have to suck it up and, be happy the economy. We're to get what they want, we'd have to go into recession like now to get the Fed to start cutting rates in March or even any point in the first 6 months of the year. And it's just not going to happen. They just need to move on. So I didn't. The Fed is on target right now. They're doing the right thing now. They should say it in plainer English. Maybe they have Hannah edit their statements. Maybe it'll be a little more interesting.
Thank you.
Sure. You're very good at it, and they certainly need the help. So reach out to Hannah, Jerome Powell, and make sure. Stop having economists write these things. So that's the first item. The second item is something we had joked about, I think, when we had Ari on, that the banking crisis that scared us all to death almost a year ago had disappeared. But maybe that's not the case, Hannah. What is batting second in our lineup?
Well, the stock that plunged 38%, which kind of reignited this fear of regional banks, but New York Community Bancorp. So
that's NYCB on Long Island is known for, they are the sponsor of what used to be the Westbury Music Fair.
Interesting.
It's like a theater in the round, which is nice. It's close to my house, so I used to take my son there to see the Beach Boys every year, and he actually got to go on stage and stand next to Mike Love and Bruce Johnson and even John Stamos, which made my wife really jealous.
I love John Stamos.
You're hard pressed to find a woman that doesn't. I think he's very popular.
Yeah.
And my son,
Full House.
grew up watching Full House, even though it was on, sniff 20 years before he was born or whatever. But
it's a classic.
All right. Well, let's get to the bad news. John Stamos still looks great, but that's not what we're talking. So NYCB had acquired most of Signature Bank last year.
Right.
And remember, the banking crisis was not it appeared that it wasn't a systemic thing. It wasn't like what happened during Lehman Brothers, where we had these credit default swaps and they were kind of insurance, but they weren't really backed by anything. And we had this financial crisis. What happened in March of last year was more irresponsibility. SVB taking large bets on long-term treasuries to get a little bit more return on their interest, and then as rates started to go up significantly as the Fed started hiking them, they started losing money hand over fist. Banks like Signature and First Republic had other issues which ranged, all came down to one thing. It's what percentage of your deposits, which are your assets, are covered by the FDIC. And if you have a large percent of those assets are not FDIC insured, these banks were paying a heavy price. And for First Republic in particular, that was part of the problem. But for NYCB, they reported a huge loss, $252 million in the fourth quarter. A year ago, they had $172 million profit, so that's a big change. Why did that happen? Well, they're bigger now. If you hit the $100 billion mark, just like we have commercials now, so we're big time. I'm expecting a limo to take me here next week. Let's make that happen, Lena. Okay, thanks.
It's a big ask, but
you don't get anything in life if you.
Anything's possible.
Tell my son that for 16 years. You're not going to get anything. I'm like, we'll feed you and clothe you. You don't necessarily have to ask for that. But once you hit $100 billion as a bank, there's more regulatory demands on you. You have stricter capital and liquidity standards, people looking at you more. And so that creates a problem when you lose a significant amount of deposits, which they did. And these loans you have made to properties, most notably commercial properties, start to go bad. So, they got hit very hard after this happened. It was almost a 40% decline. Let's watch this carefully. I mean, it's going to cause some concern for regional banks again, but too early to tell. But I just wanted to bring that to your attention. Hopefully, it just the Fed is ready to step in like it did last time to try to shore up the assets of banks and calm people down. And hopefully, people have learned over the past year that know what the FDIC limits are and don't keep any more than that in one bank, and you'll be fine. And that's hard for businesses to do. They have, like Roku was one of the people that had hundreds of millions of dollars in SVB. that's where that business banked. And who has a TV that doesn't have a Roku stick attached to it or part of the TV?
Very true.
So we'll keep an eye on this. Hopefully it will calm down and everything will be okay. Okay. Now, this next item about the key to happiness had a twist to it, right?
Shifting gears a little bit here. There's a Japanese bestseller, and it's called The Courage to be Disliked. It's pretty popular. It's basically a premise that surrounds an Austrian psychotherapist's theory of true freedom being the release of caring about what others think of you, especially if they dislike you or not.
Right.
Interesting.
I never heard of Alfred Adler. I guess that's how you pronounce his name. He is the psychotherapist that came up with the Alderian theory.
Yes, the Alderian theory.
No, but it's funny because it's like, okay, the key to happiness is not worrying about being disliked, right? Tell that to Gen Z. Oh, wait, is Hannah in the room?
What's the problem with caring about how you present yourself?
Well, I think the reasons why are people not liking you, I think is why. Like, I can relate to this as a boss and as a parent. I can't care. I want my staff to be happy, and I want my son to be happy, but if my son does something wrong, he may need to be punished. Or maybe I don't buy him everything he wants, and he's going to dislike me or resent me. But I think, when I read the headline, if you read it quick, that, the courage to be disliked is the key to happiness, I think it seems a little weird or silly, but the more you think about it, you can't, you're making your path in life. You can't worry if you're going to rub people the wrong way.
Right.
I mean, I don't do it, but other people do. Come on, Brave. My mother says people like me.
The book got into a couple key points here. Just
there's
gonna glaze right over
bullet
that.
Points
So basically, just a deeper dive into the book. They highlighted a couple key points here of being unconcerned with how people judge you.
Check.
Not, you don't have this fear of, oh, he doesn't like me, she doesn't like me, etc. And accept that you may never be recognized by others for your contributions or successes. So it's nice to be acknowledged if you do something great, but the book kind of gets into recognition not necessarily being something that should be or has to be addressed in order for you to be happy.
Right. And, when we're kids, as a parent too, you always want to compliment your child when he or she does something special or even just a little bit ordinary as a reinforcement so they believe in themselves, and that you don't want the only feedback they get from you to be negative. But I do think it is important to learn how to take criticism, even if it may not, you don't think it is just, you have to listen to it because some of it's going to be correct and we all need to get better. But you can't be expected to be recognized for everything that you do. And you can't walk around worrying about what people think of you. I think you should have a gauge of what your reputation is and, how you're viewed by people in general. But I mean, just think how much you fight with your families, your significant others. I mean, there's disagreements everywhere.
Yeah, I think it definitely is different, though, from like a familial sense to like a workplace. Like you obviously you care a little bit more about like, how you present in the workplace. So I think that it's an interesting, point to bring up.
Yeah, and look, I would say that I'm my worst critic. That I watch these back, and I sometimes I can't look at part of them because it reminds me that I'm a little follically challenged and maybe not as polished as I would like to be, or I forgot a point I really wanted to make. So it is a good thing to keep in mind. You're not everybody's going to like you, or you're not going to like what everybody says. But I think also at some point you do have to, the more negative feedback you get, so to speak, you have to think about why that's coming.
Right.
And do you need to change it? And one last thing that I would say too, from a career standpoint, that's why a mentor is a really good thing to have, because that person who you respect and value and knows you will be the first person to tell you when you're messing up. And that's, in a better environment because you're actually asking for the criticism.
Right.
But don't ask for it if you don't want it. That's something that can happen at times too.
Mm.
All right, we have time for one quick congratulations, I think. And
Yes.
And this had to do with the Wall Street Journal. They have economists try to forecast the data points, things like GDP, employment growth every year. And they were 71 business and academic and financial economists who participated in the Wall Street Journal's quarterly economic forecasting survey. And I wasn't one of them. That was because they didn't want me. I don't like to be wrong. But
you shouldn't worry about whether the Wall Street Journal dislikes you or likes you, right?
I don't think they have much of an opinion on me. I always wanted one of those digitized, when they have the faces like that. I always wanted that. I've been quoted in the Wall Street Journal often, but never with the digitized
Next
image,
time.
kind of speak. But congratulations to Belinda Roman, I think it is, based on the accent.
Professor of economics from St. Mary's University in San Antonio. She gave the most accurate forecast of the economy.
And you know why? Because she was optimistic this year, and she's actually optimistic for 23, and she's optimistic for this year. Something she said that was interesting, and I think we touched on this a week or two ago. She looks at moving averages and trend lines rather than models. Like a lot of times in economics, monthly data can be very volatile. So you look at a 6-month moving average to get more of a trend. And modeling is something that I don't really do, but this is when you're trying to find a formula to predict the future. What data points are you going to use to predict interest rates or economic growth or hiring? She also says that her students get lost in the technical aspect of it, in the math, and they forget that humans are involved, and human behavior is a big part of economics. So congratulations, Professor Roman. That is a great accomplishment.
Super impressive, yeah.
And, a very small school, although it is the oldest Catholic university in the Southwest.
I did read that.
We read enough of the article to pick up that point. Well, that is our show. Sorry, we run about 2 minutes over our target, but we'll see. We'll see if Professor Roman had forecasted that accurately. Again, we'd love to hear from you, but as always, thanks for joining, and be sure to like and subscribe all the great shows on the More Network, because again, they are great, and we look forward to doing this again next week, right?
Of course, every week.
Well, we'll be back next week. We hope you are, and bring some friends.